And welcome back. Thank you so much for joining me in today's video. Today's video is my weekly video I make for you guys regarding some early indications of home buying demand. One of those reports that I cover on a weekly basis is actually from the MBA, or the Mortgage Bankers Association. They looked at refi numbers as well as purchase applications. And this week, just announced today, which is September 20th, they announced a giant increase in the number of people who are doing refis. So refi applications surged by 13% compared to the previous week. So I'm going to discuss why that occurred, and also again discuss some early indications of home buying demand in today's video. So of course, I have a lot to share in today's video. Let's go ahead and dive right in. So when I actually looked at the MBA's report, and I saw that applications for refis increased by 13%, I really kind of researched for about an hour or two regarding how could this possibly happen. I mean, rates are around 7.3%. and have been above 7% for nearly 2 months now. So why would refis increase by 13%? It made no sense to me. So I actually did a Google search regarding this. And here's what CNBC reported today as well. And this is Diana Olick. She says, weekly mortgage demand increases driven by strange surge in refinancing. They go on to say the following here. Applications to refinance a home loan jumped 13% last week compared to the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Application volume was 29% lower than the same week 1 year ago. Refinancing demand usually moves in the opposite direction of rates. In this scenario, that is not the case, because rates actually increase from 7.27% to 7.31% this last week here. They also provided this explanation as well. It says it may also be the number of refinances are so small right now that any minor changes result in a big percentage increase, which makes sense. But here's what does not make sense though. I actually looked at the report here, which is right here, posted on today again. It says here applications increased by 5.4% from the previous week. This includes purchases plus refis, and this is for the week ended September 15th this year. They have what's called their market composite index. Again, that's total applications for refis plus purchases. That actually increased by 5.4%, but on unadjusted basis, it increased by 16% compared to the previous week. It says here the refi index increased by 13% from last week and was still down by 29% from the same week 1 year ago. So what I did is I actually called Phelan Taylor here. She's the director of public affairs at the MBA. So I sent her an email, actually texted her and called her as well, because I just really couldn't understand why this is happening. And I wanted to provide you guys with accurate information rather than just speculating. That's just kind of the goal of the channel overall, right? So I said to her, is this seasonally adjusted or is it unadjusted? It makes sense to me that the refinance index, if it increased by 13%, it makes sense to me that the refi index is actually not seasonally adjusted, because what happened 2 weeks ago, we had the holiday period due to Labor Day. So during the Labor Day week, we saw a huge decrease of applications for refis plus purchases. And then each and every year, like clockwork, we see an increase compared to the previous week here. So this increase of 13% is because it's not seasonally adjusted. Which is exactly what the CNBC made a mistake regarding, because they said it's seasonally adjusted here, when in fact the refi index is not seasonally adjusted, according to Fallon Taylor here. So of course, this makes sense because again, 2 weeks ago, we had the Labor Day weekend. So we saw a huge pullback in applications for refis, but then the following week, which is this report right here, a big increase compared to the previous week here. So I doubt any of you guys noticed that, but I noticed that. It was driving me crazy regarding why did refi applications surge by 13%? It's not due to a giant increase of the number of people who are refining. It's really due to the fact that we saw a huge decrease during the holiday week 2 weeks ago. In any case, hope that makes sense, but let's just move on here. Again, what I really focus on is their purchase index by the MBA. That's an index which measures the amount of applications for home loans in the US here. And this represents approximately 75% of all retail mortgage applications nationwide regarding refis plus purchases here. So their seasonally adjusted purchase index, which accounts for the fact we had the Labor Day holiday 2 weeks ago, actually increased by 2% from 1 week ago. Something to keep in mind, though, it's still down by 26% from 1 year ago, but the current levels right now, it's still more or less on par with the lowest levels going back to 1995 when looking at pre-pandemic levels. We've had some ebbs and flows this year and some very low points here, but when we're looking at pre-pandemic levels, we're at the lowest levels since approximately 1995. So, I mean, it is a small increase of 2%, but when looking at the big picture here, we're still at very, very low levels. So for example, here's a look at their purchase index over the past 5 years here. So as you can see right here, the current levels are way below the past several years, especially compared to pre-COVID levels. So for example, back in 2019, the index was around 250. Now it's actually below 160 right now. And of course, one of the main reasons due to this huge pullback in applications to buy houses is because average rates have absolutely skyrocketed ever since really January last year, going from 3.1% on December 27th and then increasing to about 7.08% or 7.08% as of October 24th, 2022. I believe that's looking at weekly rates according to Freddie Mac here. But of course, because rates have increased again this year, that's why applications overall are also decreasing as well. Of course, low inventory levels also plays a role in that as well. But we have this combo effect regarding high home prices, increasing rates, and low inventory levels, really putting downward pressure on applications in the US here. And speaking of refis, look at the refi index over the past 5 years. It's absolutely insane. It's been basically dead for about a year now. So our index right now is around 400 right now, which is well below the index. So for example, back in, when was this? February 2021, the index was 4,746, which of course means that the higher the number, the more applications are getting for refis. Now it's actually around 400. So the levels right now regarding refis are at very, very low levels, really on par with going back to the year of 2000. All right, let's get back to the MBA's report here because it said here applications increased last week despite the 30-year fixed rate increasing to 7.31%, the highest level in about 4 weeks. Purchase applications increased for conventional and FHA loans last week, but remained 26% lower than 1 year ago as homebuyers continue to face higher rates and limited for sale inventory. Refi applications also increased last week, but it's still about 3% below last year's levels here. No mention regarding why they saw an increase of 13% from one week ago, really due to the holiday 2 weeks ago, which is why we saw an increase last week here. It also says here, this is something interesting as well, because this is very much a forward-looking indicator of home prices in the months ahead here, because they looked at the average loan size that people are applying for. The average loan size on a purchase application was $416,800, the highest level in 6 weeks. Home prices in many markets have been supported by low inventory and resilient housing demand for available houses. They also talk about the refinance activity here, because of all the applications for home loans, 31.6% are coming from refis. And of course, around 70% are actually applications for home purchases. Also, the ARM share of activity, or the adjustable rate mortgage share, is at 7.2%. Hasn't really changed too much over the past month or so here. And what we do not want to see is this number to spike. I believe the Probably the 24-month high was around 12%, and the low was around 3%. So we're kind of right in the middle of the averages over the past couple of years now. All right, let's change gears slightly here and talk about real estate showings by real estate agents showing houses for sale to their home buyers. That actually decreased greatly during this period right here, right around in early September. And of course, because I didn't understand this, I reached out to Showing Time as well and said, "Why did your number of real estate showings decrease by 263% compared to the start of this year?" Which makes no sense whatsoever. So during the holidays around, let's just say Labor Day weekend, they tend to see about a 10 basis point decrease in real estate showings compared to the previous week. So if real estate showings were down by 10% compared to the first week this year, we should expect real estate showings to decrease to about 20% during the holiday week. So a decrease of about 10 basis points, not a decrease going from down by 11% down to 265%. So therefore, I emailed them, said, "What the heck is going on here? Is this due to the cyber attack that occurred for the MLS system or the multiple listing service?" And they actually responded to me saying, "We don't understand what you're talking about. Can you please send us a screenshot?" I did that. I haven't heard back yet. So let's just say that this giant decrease of down by about 200% is really due to the cyber attack that occurred right around this time frame when a lot of multiple listing services were off the internet because of that cyber attack. So in any case, let me just get back to what's actually happening right now, though, because it appears it's kind of fixed right now. So for the week ended December 16th, by the way, this is a 7-day moving average. This week, it was down by 3.8% compared to start this year. Compare that to 2022 at this time, we were down by 12.2% compared to the start of the year last year. And also in 2021, we were up by 13% and a giant increase of 36% in 2020 compared to the first week of 2020. So big picture here, compared to the start each and every year, we're well below 2021 and 2020, but not as bad as 2022 right now. Also, I want to share this with you guys as well. This is Redfin's Homebuyer Demand Index. This is a measure of real estate requests for home tours and also other home buying services by Redfin agents, whereas ShowingTime.com is used by not all, but multiple brokers nationwide here. So according to Redfin, based on what they are seeing from requests for home tours here, it's down by 9% year over year, and which is on par with 2020 as well, and also well below 2021 right here. And also their index has been more or less flat for about a month now as well. I also want to share this with you as well. This is the number of people searching for homes for sale on Google. That is roughly on par with last year's levels. The index right now is at 76. 1 year ago, it was at 80. So roughly the same number of people searching for homes for sale on Google compared to the same time frame 1 year ago. I also want to provide an update regarding rates, because of course rates have been absolutely all over the place all year. But as of today, September 20th, according to Investopedia.com, the average rate for a 30-year fix for people with great credit is at 7.77%. Absolutely crazy. Also, according to the Mortgage News Daily, as of today, it's at 7.28%, a slight decrease of 2 basis points compared to yesterday. Also, 15 years at 6.6, jumbo is at 7.3, and FHA and VA is around 6.73%. Let's have a look at how this compares to 1 year ago. So for a 30-year fix, 1 year ago, rates are at 6.47%. That's an increase of about 0.81 percentage points compared to 12 months ago. I would imagine this number right here may be flat very, very soon, because look what happened last year. At this time last year, again, rates are at 6.47% as of September 20th last year. But by the time we hit 1 month later, about October 20th, rates increased to 7.37%. An increase of about 90 basis points in one single month, which absolutely shocked the housing market. This year, we're not seeing that giant surge like we did last year, but we still have very high rates. If rates are maintained at around 7.3%, we should expect to see the year-over-year change to be more or less flat in the next month or so. So how does this all impact home buyers right now? I want to provide an update regarding that, because for someone looking to buy a median price home 12 months ago compared to today, have a look at this. The median price home 1 year ago, this is based on the data from the National Association of Realtors. 1 year ago, it was $399,000. Let's assume they're putting 20% down to get the best rate at 6.47% 1 year ago. Your housing payment of principal and interest would be $2,011 per month. I'm excluding taxes, insurance, and HOA because that varies greatly depending on the area and, of course, the state you live in as well. So purely looking at the increase in prices and rates, how that is impacting buyers right now. So looking at that same scenario, which, by the way, the median sold price is slightly higher compared to 1 year ago. Right now, it's at $406,700. And of course, rates right now at more or less 7.3%. So your new housing payment would be $2,226 per month, or an increase of about $215 more to buy a median price home today compared to 1 year ago. This sounds like a significant number, right? An increase of $200 more per month to buy a median price home today compared to 12 months ago. However, though, several months ago, I was reporting to you guys that due to prices increasing, and of course, due to rates increasing compared to a year ago, the difference between this year compared to last year was an increase of about $800, not $200. So the difference between this year and last year has been getting better, but still, I think we all can agree that housing affordability is a big, big challenge nationwide. And speaking of that, according to Black Knight, which is a data analytics firm that supports the real estate and mortgage industries, they reported about a few days ago here that in July of 2023, the average monthly housing payment of P&I, or principal and interest, reached a new all-time record high of $2,306 per month before taxes and insurance were included. That's the highest average monthly payment going back to at least the year of 2000 when they began collecting data on this. So the average monthly housing payment is a new all-time record high, which of course means that housing affordability is an all-time record low. This also coincides with the National Association of Realtors report, or their data, and my analysis is that housing affordability is at all-time record lows going back to the mid-1980s, which is absolutely insane. Also, they provided the changes in your average monthly housing payment compared to 2 years ago, and that's an increase of 60%, or about $871 more to buy an average price home today compared to 2 years ago. Now, keep in mind, this is for the month of July, reporting all-time record highs for average monthly housing payments. Keep this in mind, though, because in July, average rates, according to Freddie Mac, for the entire month of July was 6.84%. But in August, it increases 7.07%. And again, as of today, average rates, according to the Mortgage News Daily, are, 7.28%. So the numbers in this report, once they announce August's numbers, will look a lot worse because home prices really haven't fallen very much at all. And on top of that, rates are also still increasing as well. So what's your biggest takeaway from today's video? If you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, appreciate you. Hope you guys have an awesome day. I look forward to seeing you on the next video.